The webinar today uh, largely going to be focused on what we've been seeing in the Cherokee play, just because that was obviously such a big part of the deal. But just as a recap, we'll walk through what we thought of the deal, any of the specifics, touch on the Permian asset because it's a little bit of an unusual one, and then do a bit of a deeper dive on the new exploration play. So if you weren't paying attention to the deal or you've just forgotten, maybe the Diamondback Double Eagle deals erased all of your memories of the Maverick deal. Effectively, some high level reminders about a $1.3 billion purchase price, 3.3 times last 12 months EBITDA, which compared to recent deals is relatively expensive, but not crazy. Obviously, Double Eagle fresh in the mind at over 5. We did see some more fringy Permian stuff transact in the high 2s, but it just seems as we kind of accelerate into the back half of the 2020s, and inventory is now obviously becoming an increasingly more important part of the narrative again, that people are paying more for PUD locations. We were generally in line with the PDP valuation. We came out to about 1.6 on the Permian and Anadarko asset exclusively. And so in theory, you should be able to back into their 1.7 number once you add in Florida and Wyoming and that Arkansas border stuff. 900,000 acres net, so giant position spread out across the entire country. We'll get into why that happened and why they have such a spread out position in a couple slides. But maybe one of the highlights here is just that this very clearly increases Diversified's liquids cut. The market liked that, and we'll talk about that as well. The company is now the largest acreage holder and producer in the Western Anadarko Basin, although we're going to put an asterisk on that, and we'll get to why. And with that, now we can kind of jump into it. So the deal, high level, market liked it. We're not surprised. Increased liquids cut. It was deleveraging. It was accretive. At the end of the day, yes, it's a very spread out asset. If that had been folded into any other company, the market probably wouldn't have liked it, but that is Diversified's bread and butter. So unsurprisingly, we think we weren't surprised that the market liked it. In the days that followed, it outperformed the XOP, which if you're used to looking at the XLE or you just don't know, that's a producers only energy index. As far as assets go, Maverick's Permian asset sits in the northern fringes of the Delaware Basin. You can kind of see it in that map on the left in the blue. They've got a little bit of acreage on the eastern and kind of central eastern part of the Central Basin platform, as well as the northeastern shelf in the Delaware. And we'll talk about northeastern versus northwestern shelf when we get to that slide. As far as the Anadarko asset goes, you can see on that map on the right, Maverick in orange, Diversified in green. There is some overlap in the middle of those two, but effectively all Western Anadarko Basin, very little proper scoop stack, lots of panhandle stuff, and effectively right in what we're going to describe as the Cherokee core fairway. As far as the other assets go, they've got some fringy stuff on the Arkansas-Louisiana border that's not really prospective for hydrocarbons anymore, but is in the vicinity of some of the more recent lithium plays. If you've been following the Galvanic, Exxon stuff that's going on down there, but very small position. They've got some Greater Green River stuff in western Wyoming, tiny little bit of Powder River, a little bit of the Bighorn Basin and the Wind River Basin in the north central Wyoming. And in order to figure out, how we got here, we kind of have to do a little bit of a history lesson. So we're lucky enough at Novi to have an analyst on our team who actually was there when some of this stuff happened. But Breakburn Energy Partners fires up in 2007, very focused on top line growth at that point, and they were an MLP, return cash flow to shareholders, all about revenue growth. They were able to fold in assets around the country, including California, Florida, Arkansas, Louisiana, fringy stuff in Western Wyoming, all in the name of top line growth that maybe another company that had more of a bottom line growth would not have folded into their asset base. Obviously, 2007, we know the next year financial crisis came, entered into Chapter 11 that year, reemerges, but then again in 2016, files again, and then reemerges this time as Maverick, with EIG as their backer, who took them through bankruptcy the second time and is now obviously a large shareholder in a Maverick and now in Diversified as well. So doing a deeper dive now on the assets in the Permian Basin. What we kind of want to get across here is this is a bit more of a zoomed in map. Yeah, the acreage is on the northern fringes. It's outside of all those gray sticks. So that's effectively where we model machine learning derived remaining inventory. So every single one of those gray sticks, we have a rocks up petrophysics informed bespoke production forecast for every single one of those wells. But we do stop just shy of Maverick's position as we kind of consider it more pseudo-conventional on the shelf. The second point that I want to make while we're on this slide is that you can see that little red dot in the corner. That is the westernmost or getting close to the westernmost extent where I've seen someone test the underlying Woodford Barnett sections in the Midland Basin. Now we know that there have been tests as far west very recently in Central Andrews, and all of that just to say, bit fringy, probably a bit pie in the sky, but there is some probably low probability chance that Maverick has some exposure to some fringy Woodford Barnett stuff on the Midland Central Basin flank side. One surprising thing that kind of came about while we were going through this analysis was it's easy to look at that position in the northern Delaware and then just write it off and kind of abstract it away as not as good. And it is easy to say that. And if you look at it comped to Delaware core, you'd be 100% correct. The map on the left is showing oil EUR colored by red is very high and green is lower. Obviously, that position in the Northwest Shelf doesn't compete with core Delaware. And then if you look at the map on the right, showing again Northwest Shelf, but this time showing water to oil ratio and red being a higher water to oil ratio, you can see on the shelfal deposits that the water oil ratio is higher, generally speaking, than kind of Lee County core. We'll get into why there's a bit of a caveat to this, but before we move on to the next slide, the last thing I just wanted to touch on is if you look at the easternmost extent of that Northwest Shelf red outline, you kind of just don't see wells anymore. About 35% of Maverick's position falls in that kind of no man's land, where we don't really think it's prospective for much anymore. But a good chunk of it does fall into that kind of Northwest Shelf proper. So we've established that the Northwest Shelf in the Delaware doesn't compete with core Delaware. I don't think that's surprising to anyone. But something that did come about that was kind of surprising as we went through this was this. So if you look at that graph on the left, that is showing normalized cumulative oil. So just cum oil per foot. And it's just taking the 2021 to 2024 vintages. And the gray lines underneath it, every single one of those is a county average from the Midland and the Delaware on a per foot basis. And, maybe just by looking at where that asset was sitting, or maybe you've mentally written off the Northwest Shelf, you'd probably expect that red line to rank much lower in this peer group. But it doesn't. It kind of sits in the middle. And so one of the things we were able to pull out of this was the resource density is lower in the Northwest Shelf. You're not dealing with true oil saturated unconventional plays. So you're probably not going to get full stack development or a crazy NPV per section. But on the half cycle and on the operational benchmarking, a lot of those wells actually look pretty good from recent vintages, and they can compete not with core Delaware, but with some parts of the Midland Basin. So that was an interesting takeaway from this. And then we're going to shift gears to the kind of crux of the talk, which is the Maverick Cherokee position. Very high level, before we jump into reservoir specifics or exploration, the company is now the largest acreage holder and producer in the Western Anadarko Basin. The reason we put a little bit of an asterisk on that was because Maverick already was that. So it basically just acquired the largest Western Anadarko producer, followed by Newborn, Presidio, Merritt, kind of the usual suspects in the Western Anadarko. So on the Cherokee itself, there is not a ton of literature on this. The first thing that you should do when you're trying to mentally sort this out, and huge shout out to everyone that kind of helped me wrap my head around this. We kind of crowdsourced an academic and industry wide understanding of this. Those deeper targets, Mississippian, Devonian, so think Merrimack, Osage, Sycamore, Woodford. Those are your typical scoop stack targets. This stuff is shallower than that. It's Pennsylvanian and aged. And if you think of what was typically targeted in the Western Anadarko Basin, so Tonkawa, Cottage Grove, Hog Shooter, Cleveland, Marmaton, and EOG as recent as 2017 had a JV with Carlisle to drill their Marmaton stuff out in that area. The Cherokee stuff is below that, and it mentally in our minds we've broken it up into Upper Cherokee and Lower Cherokee because the Cherokee is typically considered a group, with the Lower Cherokee being stacked channel sands, and we'll get into that in the next slide, and the Upper Cherokee being a high TOC, hot shale, very oil saturated, that at this point is being colloquially referred to as the Excello, and I believe that's a lateral equivalent to a shale that was described in the northeast part of the Anadarko in the 80s. So here we've got our where we've defined the fairway, and again, this is coming from a combination of some academic work that was done in the early 2000s, some industry stuff that was done back then, as well as some more recent industry stuff. Probably the overarching theme here that is basically that the distal edge, or the point where that shale actually becomes prospective on the northeast side, is not perfectly defined. The petrophysics of this rock is not perfectly defined, and what is driving production on this rock is not perfectly defined. And so all of that just to say there is still geologic risk around this play for sure. You can see there's quite a few blue and gray dots there, kind of in the middle of that Ellis County, Roger Mills area. That part's generally well delineated at this point. But if all you did was look at historical petrophysical maps, you can see that the formation at least looks prospective somewhat up to the northwest, and again a little bit in the southeast. But there is a bit of a pressure gradient increasing to the southeast. So as you go northwest, in theory, you should be losing a little bit of pressure, and you do get some mineralogy changes. To the southeast, there's an emerging or re-emerging Lower Cherokee Sands area. So historically, all these formations have been drilled, but Red Fork, the Prue Sands, Skinner, Lower Skinner Sands, again, stacked channel sands, bit more of a pseudo unconventional play. To the northwest, again, starting to look promising, but there is mineralogical changes. And then as you're in the center of that play, the Excella looks thick. You can see it on logs. Resistivity is obviously high. Net pay is kind of considered the highest there. And then pressure is in that moderate range. And then the final thing we'll just touch on while we're here is complete acreage math, not risked down in any way. If all you did was look at recent interwell spacing, which we'll touch on in a second, and the total acreage area of that red outline, you can back into a total plausible about 5,000 remaining 2-mile locations in that core. Again, not risked down at all. As far as how it's producing or how it's performing relative to Anadarko peers, that rate versus cume chart on the left is showing, we've called 3 subbasins here, so we've called that whole area Granite Wash, but it is essentially Western Anadarko Basin. Scoop in purple, and then Stack in the light blue. And your takeaway from this should be that the area is competing with kind of core scoop stack at this point. Not the best of the best, but in general, I think it'd be surprising to most people to find out that the area is competing, at least at that level. If you look on a formation by formation basis, which is the graph on the right, you can see that where they intersect the x-axis, that's the EUR, they range anywhere from 125,000 barrels to upwards of 350 plus. Again, these are averages. There are individual wells that are over 500,000 projected for oil EUR right now. So ultimately, all of that wrapped up into both half-cycle economics and per section economics here. On the left, we are showing we're showing just by county average for the Midland and the Delaware. That's what each one of those dots is. What is the 6-month cume oil per foot? And then that middle jitter plot is the Cherokee wells. So it's Cherokee wells in the middle and then county averages on the sides. And the point here is just this. Again, the Cherokee is kind of even competing with certain Midland counties so far on 6-month cume oil per foot, which is a great proxy for half-cycle economics. And then if you look at the graph on the right, that is showing you in the Cherokee, how has well spacing evolved over time? So obviously, exploration era, kind of 2018, 2019, everything's done at 1 well per section, maybe 2 tops. In 2020 and beyond, we've kind of moved into that period of getting to about, I think we're 500 to 750 on the wells where we were able to get a good spacing signal, and we've cut it off with some of the recent vintages just because the data gets a little bit weird. But at the end of the day, the point is this: we have evidence of 5-6 well per section tests, at least on a extrapolated spacing basis, and they looked decently promising is the takeaway point. So maybe the one line take home point here is this: there are parts of the Cherokee that can compete on a 6-month cume per foot basis with the Midland, although it's slightly wider spacing. Again, looking at that same data, but now a little bit more chopped up by operator. And the take-home point here is this: a lot of those Mewbourne wells are in that Western Anadarko Basin. We literally just took the top 5 most productive operators over those vintages, with the take-home point again just being like, this stuff is actually competing with the core scoop stack on an operator basis, on a sub-basin basis, on a production by year basis. Okay, so we'll wrap this up, do a nice take-home point here, and then we'll open it up to Q&A. But if you take anything away from this, it should be the deal was deleveraging. It was accretive, and increased diversified liquids cut. And it opened the company up to a new emerging exploration play. that we think so far has been promising. That being said, the Cherokee is definitely still understudied. It's very hard to find um, it's very hard to find academic work on it. There's a bit of industry work that's been done, largely by people marketing assets. So at the end of the day, yeah, as you go northwest, as you go southeast, there's still geologic risk. We know there's mineralogical changes. We know that there's pressure changes. But one number, completely unrisked, you could in theory jam about 5,000 2-mile locations into that fairway polygon. And then finally, on the Permian side, yes, the Maverick asset is not in the Delaware Basin proper. If you go back and actually take the time to look at Northwest Shelf production right now, recent wells have actually been decent, surprisingly decent, and to the point where it is competitive with certain Midland Basin counties. And with that, Emily, I'll pause and we can open it up to Q&A. I think we had one trickle in already, but.
So we have from Anonymous, what is the reasoning for focusing analysis on future drilling potential when DEC doesn't drill new wells?
Yeah, there's a JV though that they've inherited through the acquisition, right? So I guess it's just about like JV cash flow. Yeah, is the short
Okay.
answer to that. I think that's the most torque to the upside for them going forward. But yeah, to totally agree. Yeah, obviously they don't, but yes.
Okay. And Stephen asked, I would assume the well costs on the Northwest Shelf are considerably lower than the deeper Wolfcamp Bone Spring in the North Delaware proper. Do you have a read on DNC costs?
I don't have a number off the top of my head. I would I think directionally that's correct. They're not, I don't think there's as much of a jump as you'd think, partially because it's hard to get up and going at scale in that area just because of the limited inventory count. But B, surprisingly, if all you did was look at average perm in that area, a lot of those rocks have surprisingly low permeability relative to some of the shales even. So that some of the completions are rather intense is all I'm saying. But I think directionally that's correct. But it's not a massive cost savings is my knee-jerk reaction.
Okay. And then referencing the first question, is Maverick the operator of the drilling JV?
I don't think they are either. I think they like Maverick had the JV. So if you actually go back and look at this, Maverick has exposure to a lot of these prolific Cherokee wells in the basin, but they don't come up in the top 5 most productive operator list. In the earnings or in the acquisition disclosure call, I'm pretty sure Diversified just referred to them as a large operator. Complete speculation. It just probabilistically, given the number of wells being drilled, it's probably newborn, but don't quote me on that.
Okay. And then do you see hedging activity changing for the companies and outside of the deal with the Double Eagle deal as well? Do you see hedging
Um,
reducing or increasing with increasing industry consolidation?
yeah, I don't think I'm gonna have a satisfying answer for you on that front. And the simple reason is just gonna be, um, we're building out our coverage list. We have 2 new corporate analysts, and their job is to purely model, almost like an equity research offering, but based on our ML forecasts. All that just to say, we have not got down the list to a diversified yet. I wouldn't say we have an informed view yet on what they're gonna do with hedges.
Okay. And then has DEC indicated that they want to scrutinize any of the new assets or otherwise commented on capital allocation strategies in the future?
Um, I'd say just qualitatively, they leaned very heavily into the Cherokee area being the torque to the upside. And then the way that we interpret it was the Permian stuff is intriguing and it plays into a future bolt-on strategy that they've already executed in the past. So So again, this is our interpretation of it, but we got the sense from them that yeah, it was going to be, you know, focus on the Cherokee area, and then you know, Permian for future upside and future bolt-ons.
Okay, that's all we have right now. Does anyone have any more
Awesome.
questions? Oh, here. How DEC was able to win this deal? Was it marketed?
Yeah, again, I think we won for the corporate analysts, and I just think we don't have that good of a pulse on the corporate side. Not enough to make a call on that right now. Awesome. Well, I think that is it, Emily.
Yep.
All right. Well, thank you, everybody. And then yeah, I think that is it. Oh, maybe there's one more coming in.
Yeah, they said I'm sending, so someone asked who are the
Yeah.
bidders on the deal?
Yeah, Scott, I think that is again, I think that's outside the scope of what we'll comment on right now. Just given the if we had them under coverage, and I'd feel more confident giving, you know, deep dive stuff like that. But yeah, at the end of the day, yeah, we'll probably refrain from commenting on that right now. So yeah, I got this one, Emily. So DEC has grown very quickly. Any risk with this strategy? I think the quick answer is, um, I mean, the short answer is yes. Breitbart ran into the exact same thing, right? Very quick, very large, widespread asset base. Um, you know, 2007 era ran into trouble with it. That being said, um, DEC to an extent has counterbalanced this with, I believe they've gone through and structured some special rules around how quickly they're going to bring down their asset retirement obligations. Um, so there's a little bit of a counterbalance to that, but yeah, the knee-jerk reaction is like, yes, there's definitely risk to having that big of an asset base that's spread out and growing this quickly. But at the end of the day, this is what they do, and this is their strategy, and they're executing on it. Um, so what is Novi's process for determining whether horizontals are targeting the upper versus lower Cherokee, TOC Ridge Shales versus Channel Sands? So the short answer is well, it's kind of two parts to this answer, but the short answer is this. We have our own grids. So we have our own petrophysical grids that we contract out. Obviously, part of those grids is TBD. And then we tag um, the directional survey data to a percent in zone type analysis. So basically, is it in the upper or lower Cherokee? So that's the first part of the answer is we tag to our own proprietary petrophysical grids. That being said, we are taking, and I touched on this a couple slides earlier, but I kind of put a little note in the bottom of this slide. There we go. So we have a new, and we're taking delivery of new grids, probably in Q2, and we're going to rerun everything with updated resolution on the new Cherokee grids, and do some actual machine learning inventory forecasting as we get into the back half of this year. So you know, wish I had that fully done today, but look out for that, I think, in the back half. Um, for any analysis on operational production cost synergies. Yeah, so um we haven't is the short answer. Like we haven't done a deep dive on it and what the synergies would be. Full disclosure, we were launching the new like machine learning based intelligence product, which is where a lot of this stuff came out of, in probably in that April area. With that being said, Oklahoma is probably the last inventory data set that we're going to put together. It's just at the end of the roadmap, solely because of the data is just obviously tricky to work through, and we're trying to make sure we get it right. So yes, shelf produced water is a major issue. So one thing, we touched on this today. There's certainly optimism for that area on uh, just on oil production and oil production per foot. There's lots of stuff that I think is looking a lot more promising than it has in the past. At a good operator at scale is probably being charged anywhere from 45 to 70 cents per barrel of water to dispose. You've got a much higher water cut as you get up onto the shelf. And if you're smaller and you don't have scale, if you're using third-party recycling, it can be upwards of like $1, $1.50 even to dispose of that water. So yeah, the short answer is water is definitely one of the risks of being up on the shelf. It's not all positive. Cool. That might be it now, Emily.
I think you're
Awesome.
good.
Well, yeah, I think we're good. Awesome. Well, thanks everybody. With that, we'll shut it off. Thank you.